when you think about sort of like the future of interest rates, I think the Fed has no choice but to raise the short end even higher right now because they're looking at the 9.1% CPI reading, and they're sort of rear view focused people there, right? They look at CPI and they look at the unemployment rate basically. And the unemployment rate's so low and CPI is so high that they're going to just keep raising until they see evidence of something breaking. So unless you start to see like meaningful declines in the year-over-year CPI number, and they could probably tolerate some unemployment before they do anything, that'll probably take a while before that unwinds. I think probably toward the end of the year, early next year is probably when you'll start.
I'm Drew Brenneman, and this is the Rise and Invest podcast. I bought my first 2 properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor. Welcome to the Rise and Invest podcast. I'm Drew Brenneman. We're back with another episode today. Today's guest is Phil McAlister. Welcome.
Hey, Drew. Thanks for having me.
Great. Yeah, Phil and I, we've known each other, but really just sort of online. We're both on Twitter a bit, and kind of saw Phil put out some things that I really resonated with me, some takes that I really agree with, or things that I've explained to people pretty often, and see someone putting out something similar, and then also some really unique insights. So I wanted to get him on the podcast today and pick his brain.
Yeah, I'm excited to do it.
Great. Well, yeah, I think before we dive in, if we could, just want to remind everybody to, like and subscribe and leave a review for the podcast if you can. That really just helps others hear about the podcast, get the word out, and get, more great guests like Phil here. So
awesome.
Great. Well, yeah, if you just want to maybe give a quick intro on yourself, and then let's jump in.
Sure. Yeah. Phil McAlister, real estate guy by trade, work kind of larger real estate deals nationwide. But here in a personal capacity, just kind of based on what you talked about, I like to also spend some time in the research kind of macroeconomic field and put my thoughts out there. So just excited to kind of get into it.
Yeah. Great. Do you have like a degree in
finance and economics? Was kind of my double major back in college. Yeah.
Okay. Nice. Yeah. Great. Yeah. Cause I know it's a passion, but then also you had some training in it too. So.
Yeah. It's funny because a lot of the like academic side of economics, you almost have to forget about. And I learned that the hard way as you start getting into like the numbers and figuring out what works and what doesn't. Like a lot of it is like the stuff the people at the Fed are reading about or something. It's just kind of like dry theoretical stuff, and half of it doesn't even apply. So you almost had like a secondary education in the real world, after college. So
that's interesting. What's something that then didn't and once you got to the real world was different maybe than the
Well, a lot of it is theoretical, right? So you'll hear things like the Phillips curve, which is the idea that employment and inflation have a clear trade-off between the two. And people are talking about that right now with what's been going on with inflation. And then it turns out that if you actually take the time to read the paper that was released by Phillips, he actually even says that it's specific to real wages and not the general price level. So a lot of what people say about general prices are going to rise when unemployment's low, there's like no statistical relationship between the two in real life. And it's just complete nonsense basically. So,
and it's basically then misquoted out there, right, if you will, right, applied to something else. Interesting.
Yeah. Where people will just assume that, hey, unemployment's low, so inflation is going to be higher right now. There's no evidence that actually happens in the real world. His study was actually based on real wages at a time when the gold standard was in place. And so he proved that when the unemployment rate was low, real wages would rise, which is like Econ 101, right? Because there's less supply for labor, so you got to raise the rate. But nothing about general inflation at all was inferred by that. Yet, half the economists out there still talk about it like it matters.
Interesting. Yeah. And just I'll keep trying to, if we start getting into terms, I'll try to be help define them. But factored in inflation in that.
Right.
Right. So then that's where, right. That makes a lot of sense. It's interesting to hear. Yeah, that kind of comes up with, could start controversial right away with rent control. It's interesting to hear people talk about that where, how if you took even Econ 101, less supply, it's going to make the prices go up on what's not restricted.
Right. Yeah. And it's one of those things where you get, I'm assuming well-intentioned people that are pretty smart people, and they think that the economy is this machine, and if I turn this knob or twist that variable, then I'll get this output. But in the real world, that's just not the way that it works, and you really can't outsmart the economy. It's like rent control is like one of many examples of that, where I kind of think of like one of those kids' toys where it's kind of like a water balloon, and if you squeeze it on one side, it just bulges out on the other, and if you squeeze it over here, it'll just bulge over there. So like you can't actually make the balloon bigger. You're just kind of like trying to squeeze it around, and if you squeeze it on both ends, it'll just burst, right? And that's like with rent control, it's the same thing, right? If you cap the level at which rents can go, all you're going to do is also create this big gap between the demand and the supply for units, and then you get kind of a lot of the problems that you see in places that have the rent control.
Right, and then if you get less development, and then you're going to have less supply.
Right.
Less supply, that would move prices up.
Right. And the quality of the housing stock gets worse, right? Because landlords have no incentive to improve it if you can't raise the rents. So there's just a lot of secondary problems that just aren't really well thought out.
Yeah.
That process.
You really see that in like cities like LA, where you have the rents are so high on the non-rent controlled units, right, because all that demand's being pushed on just those, and then a lot of the rent controlled, older units, they're not in great shape because these folks there's no turnover of the units, there's no ability to invest in your property and raise the value or income from it while the people are living there.
Right.
So,
and then of course you get the people gaming the system, right, trying to hold on to their rent control units and then go have like a second home somewhere else, which is all kinds of stuff.
I saw a tweet about that. The one guy who tweets about Joshua Tree, California a lot.
Oh, right. Yeah.
Where someone who is buying a property from him, I think rents has a rent controlled unit as a tenant in LA, and they're buying like $1 million something house in Joshua Tree.
Yeah, it's wild.
Yeah, but then I think so. One of the reasons I wanted to get you on the podcast, one of many, but like you had a really great take on something that I feel like I explain a lot, so I wanted to get you on here and talk about that. But so interest rates are obviously a hot topic now, and the Fed, and I can't tell you how many times, and you probably had to deal with the same thing, but someone you're talking to says the Fed's going to raise rates by 75 bips, 25 bips, whatever it is. And the bips, that's just the, 0.01% of a percent. So I guess I said percent twice there, but that's, so 10 basis points would be 0.10%.
Right.
So if it's easier to say it with basis point than 0.01. But if, many people have the understanding incorrectly, where if the Fed's going to raise 25 basis points, say on the Fed funds rate, that means mortgages, whatever, are going to move up exactly 25 bips. And so how does that actually, what's the actual impact? How would you explain to somebody?
Yeah. So the Fed, basically they can do two things, or as of now, they're doing two things. They change the federal funds rate, and then they can do the QE thing. What we're talking about now is really the federal funds rate, right? Which is an overnight rate that banks can lend to each other, or they can go to the Fed to get that money. So the federal funds rate essentially pins the short end of the yield curve pretty close to wherever they're going to set that federal funds rate, because you could either go to them or you could go to a repo market or whatever. So, 3 months and under, that stuff's going to track very closely to the federal funds rate. Up to about 2 years, you'll still see a really good correlation on the yield curve. Once you get to like 5 to 7 years, it starts getting pretty murky.
And by the time you get to Treasuries, so
Treasuries,
2-year
right.
Treasuries, 5-year, 7-year,
right. And by the time you get to like a 10-year Treasury, up to like 30, there's very little, if any, relationship between what the Fed's doing with the Fed funds rate and what's actually happening on the long end of the curve. And then you get into, on top of that sort of risk-free curve, there's a spread associated with all those other loans. So whether it be a mortgage loan or a business loan or a business issuing bonds, the lender's going to bake a spread in on top of that risk-free rate to compensate them for making a loan to a borrower that carries risk. So those are the components that are going to move around when the Fed raises rates. But you can't think of the term interest rates as like one singular thing. They raise one particular rate, which affects some other rates differently than other rates, but it's not by any means like a one-to-one relationship. And I tweeted about it. I actually posted who doesn't think the Fed controls the 10-year rates, the Fed, and I linked to an article on the Federal Reserve website that actually show that, where they say the impact on the 10-year, you can't really see it based on what they're doing with the Fed funds rate. So the 10-year rate is really based on the economy's expectation or the market's expectation of economic growth and inflation. So it's kind of like what you're seeing now, right? We just saw a big CPI number come up, inflation's coming up. The 10-year actually went down because, the market is anticipating, yes, the Fed's going to raise the short end higher, but going forward, that's going to mean economic growth is actually lower and the prospect for inflation continuing higher is actually less. So you're getting the yield curve inverting for that very reason. So in that it's a good example of how, the Fed's certainly not pushing the long end up at all.
Right. Yeah, it's interesting. Even when usually the context, and that was the tweet I was referring to, or that I thought was great because I didn't have a source to point people to. I just explain it. But now it's like, well, here, take a look at this article from the Fed where they say they don't even do it. But also, right, to your point where that's not, you're taking out a commercial loan and you're thinking the Fed's is moving your rate in a one-to-one relationship. There's not, usually these commercial loans are more priced off of either where, let's say, like the 10-year Treasury is plus a spread, or some of these, they're really more the end lender or buyer of it. They're also looking at investing in commercial bonds. And so corporate bonds. And so you have, there's a relationship with that. That's probably more indicative of what your rate would be. And so doesn't have as nearly as much to do with the Fed. And
Right.
and also too, like rates just ran up. So like, then depends on what your bank's doing or your lender. Like, are they going to widen their spread or are they going to reduce it?
Right.
So I talked to some banks recently and they're saying we're tightening our spreads. I don't know if it's believable or not, but they're like, the rates are so high. We're trying to do something here to make it make sense to, take a loan from us.
Right.
So then that, if you don't know what's going to happen with that component either. So there's a lot of moving pieces to your rate.
Yeah, exactly. And you brought up a good point too about the way banks will treat that spread, right? In a situation where the banks are perceiving that there's a lot more risk out there in the economy, that spread might widen. But right now there's a ton of banks out there with a ton of money to lend, right? So as the underlying treasury goes up, if they want to stay competitive, they're going to lower those spreads so that the all-in rate actually doesn't go up as much as you would think either. So a million moving parts, really complicated, and the Fed has very little to do with it at that end. Now, if you have a loan that's based on SOFR rate, right, that SOFR rate is another overnight rate that's going to track really closely with the Fed funds rate. So if the Fed raises the Fed funds rate, that SOFR rate is going to go up in almost a one-to-one relationship. But then still, there's going to be a spread over the SOFR rate. The caps that you might have to buy with a floating rate loan are going to change. So your all-in borrowing cost still isn't going to change. But on those, variable rate loans, you will see a closer impact. But once you get to the stuff that's priced off of the 10-year, there's no point in even really trying to think about what the Fed fund rate is.
And then, so longer term commercial loans, so on investment real estate, let's say, what do you think those, if they're tied to anything, probably most closely to 10-year Treasury or the Treasury that corresponds with the loan, what do you think would be the answer on that?
Yeah, it's usually, the banks usually will quote you, right? Like a 10-year Treasury plus 160 over or something like that, right? So yeah, you have that base component, which is whatever risk-free rate they're going to use, and then whatever spread they're going to tack on. So if you're looking at a 10-year loan, it's going to be the 10-year Treasury, and then based on supply and demand factors and risk tolerance, what's the spread going to be over that? Basically, is the way you think about it.
Yeah, it makes sense. Yeah, and then we've done on some deals like things we're going to hold longer term, loans that have swaps on them, and so that a lot of times you're being quoted as this year. Let's say you're doing a 5-year loan, it's the 5-year swap rate,
right?
Plus a spread,
right?
So that's why I've never. Sometimes I feel like it's right tied in with the 10-year Treasury, and that's how I used to think I was pricing my agency loans, Freddie and Fannie,
Mm-hmm.
where they'd be look at the 10-year and that's roughly what happened to your rate. But then I feel like that was not as obvious of a relationship maybe anymore for me, at least. I don't know if that's.
Yeah, well, it depends, right? If you're doing 5-year loans or 7-year loans, it's going to be more based on that other piece of it too. And swap rates don't always behave the same either. So it all kind of depends on the underlying structure of your specific deal.
Yeah, it makes sense. Yeah, and then for any thoughts on? So you mentioned SOFR. So a lot of these floating rate deals, the index that they were used, so for variable rate loans, switched from LIBOR to SOFR. That's something I haven't studied up on the differences between the two. Is that you got any knowledge of that?
I don't have any super useful insights on that. I haven't looked at specifically what changed, but I think the basic idea is the same, and it's just looking at sort of those short-term lending rates between banks, and then pricing loans off of that. So I think they behave relatively similar to each other, and it's probably just mechanically slightly different. But for dumb real estate guys like us, probably doesn't make a big difference.
Yeah. Okay. No, I know. I didn't study up on the difference. I know this is just, if you want to do that type of loan, this is what everyone's moved to. I did study up on the different types of SOFR. There's some loans are done where it's the rate's based on the 30-day average of SOFR.
Right.
Then there's a rate called term SOFR. I saw something quoted with daily SOFR. And really, I think they all kind of, you end up getting the same thing. It just kind of depends where you start. Like if rates are rising, either probably the 30-day average is going to be the lowest because you're grabbing some rates from before when they were lower. But I don't know if that ends up really mattering, because whenever rates come down, your rate will stay higher longer. I would think it's got like a partial lag on that.
Right. Yeah, it's almost like the preference of the lender, basically.
Yeah. What do you? And maybe that's something to jump into. Do you have any thoughts on when so we've just had interest rates run up a lot. We're shooting this in mid to late July here, 2022, and rates have ran up a lot. What are you kind of thinking could happen? Where I had heard, or I guess to set up the question fully, I had heard someone say so when the Fed raises rates from the first time the Fed raises rates to the first rate cut, the shortest time that it's ever been was 2-something years, and the longest time was 3-something years.
Yeah, it's a good question. I mean, I think first of all, you have to almost throw a lot of history out the window when you have a situation like this, because we're just seeing something that's really never happened before. You get this global pandemic and this insane amount of stimulus and Federal Reserve money printing and all this stuff, and then it kind of whipsaws back and forth. So it's really tough to know, based on historical standards, what's going to happen this time. And you also got to remember that the Fed is full of human beings that have human emotions, and it's really hard to game a political beast like that and figure out what exactly they're going to do. But generally speaking, I think the important analysis you have to go through is you have to really separate the short end of the curve from the long end of the curve. And you got to understand that pretty much whatever the Fed decides they want to do at the short end of the curve, they can do it. But the long end of the curve is really going to respond to what's going on in the economy. So if you look at what's actually happening in the economy right now, you have, at least in rate of change terms, you have pretty much everything decelerating right now, whether it be, the new orders component of the ISM indexes or the Federal Reserve surveys, all the regional Feds like Philadelphia, Richmond, Chicago, they all do their own surveys. Everything's headed down and pretty quickly. Consumer sentiment's as bad as it is in the deepest recessions. A small business survey sentiment just came out, just horrible, as bad as you'll see in any recession. So all that stuff is sort of pointing in the wrong direction for robust economic growth. And I think all of this high inflation, I think, is kind of peaking out right now. I think that that'll start to come down toward the end of the year as well. So at the long end of the curve, it's really pointing to rates starting to have more downside than upside based on where they're at now. And it's already starting to happen, right? Mid-June, I think 10-year hit 348. And now it's below 3 again already. So it's been a month, right? And it's already knocked 60 basis points off. So when you think about sort of the future of interest rates, I think the Fed has no choice but to raise the short end even higher right now, because they're looking at the 9.1% CPI reading, and they're sort of rear view focused people there, right? They look at CPI and they look at the unemployment rate basically. And the unemployment rate's so low and CPI is so high that they're going to just keep raising until they see evidence of something breaking. So unless you start to see meaningful declines in the year-over-year CPI number, and they could probably tolerate some unemployment before they do anything, that'll probably take a while before that unwinds. I think probably toward the end of the year, early next year is probably when you'll start to see, CPI actually on a year-over-year basis being as low as we're used to seeing it or close to it. Because if you think about it right now, even if on a month-to-month sequential basis, CPI just goes straight sideways or even down a little bit, the year-over-year increases are going to be really high because of what they're comping to from the year before.
Right.
So until you kind of catch up to those comps toward the end of the year, those year-over-year numbers are going to be high. So the Fed's going to look at that and they're just going to keep hiking. But what I think you'll see is that the long end of the curve is not going to budge, and the short end is just going to keep going up And even though the 2s and 10s are already inverted, now you're going to start to see like the 3-month Treasury move closer and closer to inverting against the 10-year. And then typically what happens then is you get the recession and the higher unemployment and that kind of thing. So
yeah, and the reason that the 10-year, just to try to explain this further, the yield on the 10-year would go down because more people are buying 10-year Treasuries because they're anticipating, let's say, not a good return from the other risk assets. There might be a recession coming, so they want to get their money in Treasuries. That's where you're going with where you could see rates dropping with the 10-year, or why would the 10-year rate continue to drop?
Yeah, so in shorter term intervals, when people want more risk-free return relative to where else they can put their capital, they're going to put it in 10-year bonds and 20 and 30-year Treasury bonds, right? So there's going to be buying pressure from that. And then just more generally, if you look at what actually drives the long end of the curve, 10 to 30 years, and that is the market and investors trying to essentially handicap where they think inflation and GDP growth is going to be in the future. So, in a situation like we have right now, the way you got to think about it is there's a sort of a structural component to GDP growth, and then there's a cyclical component to it. And the structural component to GDP growth hasn't changed at all after all this stuff. Basically, it's going to be how many people are working and how productive are those people. When you sort of wash everything out and just do the math on it, that's what's going to drive your GDP growth. And if you think about it, it kind of makes sense, right? All of the goods and services in the economy, you add up the value of all of them, and that's essentially how much people are making is what is available to consume in the economy. So if you look at those numbers and the trends behind those numbers, that's going to be driven by your workforce growth and your productivity rate. And none of that has really budged in 50 years, right? Like you had the big peak in the 70s and 80s, and since then, and you can track it really closely with CPI, with nominal GDP growth, but that growth in the workforce has just been steadily coming down since then, to the point where now it's 0, 1, 1.5% workforce growth. So you can't grow an economy faster than you're growing the workforce over long periods of time.
Yeah.
And then you tack on their productivity, right? As they get more productive, the same amount of workers can make more stuff, so you can tack that on. And when you add those two together, structurally speaking, GDP should grow at like 1, 1.5%, 2%, maybe 2.5%. That's kind of like what's baked in the cake for GDP growth going forward. So the long end of the yield curve is going to reflect that, plus some idea for inflation. And inflation also, over the long term, when you have an economy that your workers aren't growing, your demographic is aging, those older people don't spend very much money. It's really hard to constantly have demand pushing faster than supply. So if you look at Japan, you look at Europe, you look here, you look anywhere, as that demographic trend rolls over and as the workforce starts to grow really, really slowly, there's very little inflation in any of those economies. And I think that's what we have going on sort of as our base case right now. So, 1, 1.5, 2 plus some small amount of inflation. So, 150 to 250, maybe 350 at the high end for a 10-year yield would probably make sense, bouncing around in that range. And then when the economy is cycling down, you would expect the 10-year to be toward the bottom of that range. And when the economy is running hot, you expect it to be sort of towards the high end of that range. So that's kind of the base case for those rates. And I think the people that are looking at this inflation and saying that it's going to be some sort of like long-term thing like we had in the 70s, I think they're just not looking at sort of those underlying factors that are kind of telling us that this is more of like a one-off thing that's going to correct itself over time.
And what was the range you gave for the treasuries?
I think the 10-year is probably going to be like 150 to 3 is probably going to be where you'll see it bounce around. It might overshoot or undershoot depending on how good or bad the economy is doing cyclically, but I think that that's really where that growth and inflation is going to make the market want to be. And obviously shorter term, anything can happen, but I think sort of longer term, that's where I see things headed. And I think it's going to be, you could look at Japan or Europe as good examples of that, right? Because they're kind of right ahead of us on those demographic trends and a little bit worse than us. So you can kind of see how their economies have tracked that. And as you just get that slow growth and that low inflation, those long bonds just kind of hang around toward the low end of the range.
Download our 100+ page passive investing guidebook today. Accredited investors can sign up for our multifamily investment opportunities as well by hitting the Invest Now button on our website. Now back to the show. I mean, we're still relatively young. I got started doing real estate in 2005. And so, where well, what was happening in the 70s when rates were 12? None of these, kids seen this, and
Right.
but the thing is things are a lot different now. There's where, right, for all the trends you're talking about, where in the whole economy is really, it's not, I mean, a lot of the government's borrowing is longer term. You're talking about 30-year, 10-year treasuries are taking out. But I mean, the whole system is almost now just like set up for lower rates,
Right.
As well, where so that's a kind of, I'm sure I don't understand that as well as you do, but that's something I've thought about as well, is where, right, we're not growing that fast. We're getting increased productivity. So the way you broke that down, the math, that makes a lot of sense, where how GDP growth could be in the ones all the time, because that's how the population's growing. And then you add on a little bit more for increased productivity, but it's not going to be like, some of these countries where they're printing out, these, huge figures like China, which who
Right.
knows what those are even about, because I don't think they have much population growth, but somehow they're just,
Right.
you know,
Right. Yeah.
but
So,
they're,
and then the only thing that's going to increase it over that kind of baseline level is if you find some way to add workers in, right? So it could be immigration, could be a change in the participation rate for labor, which doesn't seem likely for us. And immigration's been down for us as well. And then obviously, if the unemployment rate is high, cyclically, like if you have a recession, unemployment rate goes to 10 or something, then as the economy turns back to growth and you start pulling those people back in and working your unemployment rate down, then you'll have growth rates in the 3s and 4s until you get back to that, like, low kind of full employment level. But that's really the only way mathematically for that to happen. And when people talk about rates in the 70s, it's like, okay, well, what else was going on in the 70s? You had the most incredible population boom in the history of mankind, relative to what the existing population was when those baby boomers came through. It was just insane. And, labor force growing at, 3% a year, 4% a year. And outpacing the economy's ability to supply the goods and services for it. So you just had this relentless inflation because you have people that are, starting their lives, getting new jobs, buying houses, doing all that stuff. Bank credits expanding, credit cards came to be pretty big during that time period. So all of those things were, a lot of inelastic demand from those people because they don't, like, when you're 24 years old and you buy a new house, like, you just need the couch. You're not going to be like, oh, darn it, couches are expensive now, I better not buy one. Like, you're not going to sit on the floor, right? Like,
right.
you're going to buy the stuff you need. So, and that whole dynamic is just not around anymore. So to go back to that kind of growth and inflation, you'd have to, sell me on some reason why we could expect that to happen when you only have your workforce growing at 1% a year and everybody's kind of old now at this point. So, that's where I think people get a little bit lost, is that they just see a high inflation number and they say, let's comp that to what else do I know, right? Let me find my next comp. And your comp is the 70s. So you just assume that it's going to look like that when the fundamental reasons for it are just so different, right? You had, that fundamental growth story versus now where you just have, like, the government taking a bunch of money and cramming it in there. So you get like this one-time shot where everybody's got a bunch of money that they're trying to spend and the economy can't, support it all or supply all the stuff they want. But as soon as that money goes away, there's no more people being born. There's no more massive, growth in the workforce. So where's that demand going to come from? It basically just got pulled forward, not, created in a sustainable way.
Right. So then given that, when do you think inflation's gonna, you said some point next year we'll start seeing numbers go back to more normal inflation numbers, or what's sort of the
I think so.
say?
I think it's going to be probably early to mid next year. And I've already been early on this for sure, because if you look at kind of the way things were trending toward the middle of 2021, you were starting to see things roll over back then, and then started to head down a little bit in early 2022. And then the Russia invasion happened and you had oil go crazy, gas go crazy. But to be clear, that didn't have anything to do with why the inflation started, but it certainly had a big impact on it stretching out for a while. And you could even see that if you look at, the 5-year break-even inflation rate or the 5-year forward inflation rate, whichever one you like, you could look right at the end of February when Russia invaded, the rate was kind of coming down and inflation expectations were coming down, and then it just shoots up. And now it's been working its way down again, but that certainly had like a several month prolonging period on it. And I think something like that, is always in the cards. You never know what's going to happen on the short term. But if things kind of stay the way they are now, with real incomes going down, production going down, it's going to be really hard to see inflation stay at these levels. I think we may have seen the high in the year over year. and then it should start to trickle down. But you don't start hitting the really high comps until like December, January, February. So that's going to be when those year-over-year numbers really start to come down. Because kind of like I referenced earlier, even if month over month inflation actually goes down a little bit right now, it's still just going to be big increases because of how much it shot up in the meantime. So I think that's kind of what you'll see is that, sequentially, the month over month change will start looking a lot more like it used to look, which would equate to eventual year over year growth in the 2, 3, 4% range. But when you start taking a month over, the monthly year over year change, it's going to take a while for that to start chipping its way down.
Yeah, and then so to get in where you're starting your year over year comp from a high number, really that's so once you get into like December 2022, then you'd say now you're comparing with December 2021 when there was high inflation.
Yeah, basically somewhere around there. I don't know when the exact month is going to be, but when you look back to kind of what was when inflation was ramping up toward the end of last year again, now this year when you'll have kind of a softening economy comparing to that year, then that's when you'll start to see that year over year number.
Yeah.
And I think that's kind of what you're seeing in treasuries already, right? You're seeing not only the inflation expectations in the bond market, but also the 10-year through the 30-year treasury kind of sagging already, right? Because I think the market knows that, if the market believed that inflation was going to be 9% for a long time, you just wouldn't be able to buy bonds at 3%. Why would you make negative 6% of your money, right? So I think we're kind of already seeing that, and it's just going to take some time for it to actually filter through the numbers.
Yeah, that makes sense. And also too, and to your point on energy and Russia, Ukraine, where, when I was watching CNBC and they were explaining what was up the most, and energy was like such a huge component that in housing, obviously, of like big things driving the inflation number. So then if you didn't have that energy piece pushing it up, that we would have, to your point, already, we would have lower inflation numbers we'd be dealing with. So that I could see what you mean by it prolonged it and also exacerbated it.
Right. So, yeah. I mean, really, food, energy, and rents are going to be the three big ones to watch. And oil and gas now are already down big from where they were in June. So that particular contributor in July should be, unless you get a big spike at the end of this month or something, that should already start to kind of tamp it down a little bit. And then food, that's a little bit tougher to game. I don't know much about exactly how that all plays out. And then rent, the way it's kind of quirky the way that rent gets factored into the CPI. It goes on a big lag. So all the rent that's hitting the CPI now is really like the rent growth from like almost a year ago. It's like 9 to 12 months is when the big rent growth actually makes its way into the CPI. So that's the one component that's actually going to start pushing CPI up as everything else is going to fall. So it's going to be kind of a little bit of that, energy coming down while rents are going up kind of thing. So even though I think rents are probably starting to flatten out a little bit right now and their growth is going to start to moderate in real terms or in real time, it's not going to filter into that CPI for another 6 to 9 months either. So it'll be really interesting to watch how that all plays out. But I think, again, if you just go back to longer term, like structurally what's happening, and it's clear that we have the economy from a structural standpoint that is supportive of just that low inflation, low growth. So I think the burden of proof is on the people that think we're in a new regime now. I think,
the high
as crazy as it
interest rate
sounds for me to
inflation.
say, right. Yeah. As crazy as it sounds for me to say, like, oh, we're going to go back to these inflation rates. Like, all I'm really saying is that the economy is going to go back to being the way it always was after this crazy COVID stimmy nonsense happened. Right. So the people that are saying like we have something entirely different now where we're going to have long-term sustained inflation, I think really that side of the argument, and they could be right. I mean, I'm not saying
where would
I
that
have
come
all the
from,
answers,
though?
but
I mean, the supply chain will eventually get fixed, and population's only growing so much. I mean, what's it going to come from?
Right. The only thing, so there's a decent argument that I've heard that it's going to come from deglobalization. The idea that part of the reason why inflation was so low is because we could offshore so much stuff and take advantage of the really cheap labor in China and in other places. And because of what happened with COVID, people want their supply chains closer to home. So they're going to bring more stuff here, which means higher wages and more expensive stuff. I don't know if that's going to happen or not. It's reasonable to think some of that's going to happen, but even that, you're not waving a magic wand and creating more human beings to do the work, right? And so if you don't have more people working, you got to find a way to make them more productive. Otherwise, you're still just not going to get that growth. So the only other thing that I could think of is sort of a psychological shift for inflation, because one piece that we haven't really talked about is the psychology of inflation. And there certainly is something to that, right? Where you worry that my dollars are becoming more and more worthless, so I better go spend them now before they get even more worthless. You kind of lose faith in the government's ability to pay off their debts, and you think that they're just going to kind of keep printing. That could happen. That's what happens like in Zimbabwe and stuff when people just all of a sudden lose faith. And it wouldn't happen to that scale here, but that's possible too. There's no evidence of that happening. And when you look around the world, you look at, I think we're just the cleanest dirty shirt in that department. So, China, no one's going to use Chinese currency or think that that's going to be any better. You can't trust that. Europe's in worse shape than we are. Japan's in worse shape than we are. So you look around and you say, well, what, who would, where would you go if you didn't want to get rid of dollars? And the fact is that, we're just the safe haven country. So our bonds and our dollar are going to have a constant bid under them. So I don't see that being the case either, but we'll see. Time will tell. But I think by this time next year, we're going to know one way or the other, but I think we're going to be back to like the post GFC time frame where it's like the Fed's trying their best to get 2% inflation if they could even get it, kind of thing.
Yeah. And then the Fed can say we did our job. We raised the rates, we fixed everything.
Right. Yeah.
All good. But yeah, that in the psychological component, that's a good point, because then I've seen that sort of a little bit just anecdotally, like currently, and then something my parents talked about when they bought a house. So both my parents are born sort of at the tail end of the baby boomers. Mm-hmm. So my dad's always talked about, I kind of had like a bad deal, if you will, like from just purchasing things. The baby boomers are always in front of me, pushing up the prices of houses or whatever. And the way he described the early 70s with inflation was, they bought a house, I think it was in 1972, 1973. Mm-hmm. And they were like, if we didn't buy a house that year, we would never be able to afford one. They were going up 12%, 15% a year. If you say your house was, their house was $100,000, and the next year it's going to be 115. The way this is a psychological, you don't know for sure it's going to go 15% year, but the way he felt was, if I wait in 5 years, this thing, it's going to be like 160 something.
Right.
So then they stepped up, pulled that purchase forward, and for what their incomes were, got real aggressive on what they bought. So that's, and then today I heard, one of my sister's friends was talking about a car they were trying to buy, mm-hmm. and he was having a real hard time getting this new car he wanted, and he was under the impression that used cars now they're actually more expensive than new cars, and that that's used car prices have gone up in the last crazy couple of years we've had, but they're not generally, unless it's like a car that is under just crazy demand, like some of these Teslas were, or if you want to get like the new Range Rover that just came out. But yeah, things do go over list price. But that's not, your average used car did not all of a sudden, that's like 3 years old, just triple in value and go up past. But that was his impression. So he was like, I never looked at used cars. I thought they're more than new now. And he's like a smart guy. And right. So it's just, the thing was, he just heard its prices are going up on used cars and kind of took that as like, well, why would I buy a used one? Then I could buy a new one at a regular price, if you will.
Yeah.
So, but.
And I think you bring up a good point in general too, which is just like how much the narrative of the day impacts people without really like deeply looking into it. Right. And it goes all the way back to what we started talking about with the Fed, right? When you just see a headline that says the Fed's raising rates, you think, oh, my rate is going to go up, or, you
right.
just think you're right. You hear used car prices are going up, so it must be the wrong time to buy it. But I think so much is really just driven by that. You got to be careful to kind of dig in under the surface and really see what's going on.
Yeah. So then, to kind of wrap up the inflation talk, is what do you think the Fed should be doing differently, or is there anything you would, if you were running the Fed, what would you be doing now?
Well, if I was running the Fed, I would abolish the Fed and then I would resign.
Okay.
But I think that they can't do as much as people think they can do either, right? They have this tool that they can move the interest rates around, and they can try to, talk the market into doing what they want them to do, the expectations channel, they'll call it. So like if you saw like the run up in the 2-year Treasury, a big chunk of that was when they started talking about how much they were going to raise rates, and it kind of shot up at the short end to front run them. So they can have some impact, but I think a lot of their impact is really on financial markets and putting a bunch of liquidity into the system so that capital markets go crazy and you get higher stock prices and people wanting to lend and borrow and things like that. But in terms of controlling inflation, I don't think, they could do it if they try hard enough, right? If they want to raise the rate really high to the point where, financial assets collapse and the wealth effect takes over, people don't want to spend anymore, or people get so worried about it that they really pull back, they can have some impact. And then, if they can get borrowing costs on the short end high enough to really start to impact people's, buying decisions, they can have a little bit of an impact. But you even heard Powell say it, right? I remember the line where he said, "Oh, we're learning how much we don't actually know about inflation." So it's basically like admitting that they don't really even know how much inflation is going to go up. And then I was listening to his last conference as well, and he said a big portion of this inflation is energy related, and we can't control energy prices. Yet we're still going to keep raising rates until we see the CPI go down. So like they'll even admit to you that like a lot of this stuff is somewhat out of their control, right? If you parse their comments enough.
Yeah, that's interesting. I mean, they're doing a decent job, slowing down some industries where, for me and you in real estate, it feels like, why would anyone be doing this? You're raising rates. It's harder to do these deals now with higher interest costs. But that's in a way sort of their goal for the average person living in this country. Like they're not concerned with what interest rates are necessarily. Right. They're worried about the price of gas and food. Like they're not making these, these types of investments. There might be a customer of them, they're a renter. But yeah, that's because then you raise the short-term rates, and there's going to be shopping centers or apartment buildings that would have been bought. That might have been a deal where you're going to buy it, you're going to renovate it, then you're going to put your permanent loan on later or sell it, and then that would be one of the SOFR plus whatever spread deals where now the rate's higher. Deal doesn't look as good. Maybe it doesn't happen. The current owner says, well, if that's the price, I don't want it. I think this interest rate stuff, they agree with you. It's going to be kind of it's going to shake out in like a year or two. And I don't need to sell today. Right. And that's one less construction project for people to work on. That's one less thing for a lender to do. There's less work for attorney. So they are slowing down some things, because I got to imagine that the transaction volume in real estate is going to be slower. I mean, we've seen in some of these deals where it was real reliant on that sort of short-term borrowing and also future growth, let's say, where you're buying and you're banking in a lot of growth and taking on, and something that you're not holding long-term either. You're making a real tough bet now on like where interest rate's going to be in 2 years, what's going to happen with my rents. If you're buying something long-term, that's going to smooth out. If you share the view you do, and it's similar to mine, where you're going to do a 7-year hold. This is just going to be maybe a choppy first couple of years, but it's still, you're going to like your basis. I mean, there's very few periods of time, like if you look at it over 7 years, where you wouldn't have done well in a real estate deal. So, but to kind of tie that into inflation, like they are having some impact because they've slowed down, I think, the housing market and some of these, commercial transactions.
Yeah, some of that's definitely occurring, and it's occurring more really in the capital markets side, right? Like you said, with people not being able to be as flexible with some of their loan terms, and some of that needs to happen because it was really frothy. But some of that froth, you also remember the froth was created by their low interest rates in the first place, right? So it's kind of like, to me, like I don't think that any human being should have the hubris to think that they can like manually command and control the economy and get things right. And I think that's why the Fed has a reputation for overshooting on both ends and creating these bubbles. And, I think if you look at most of the boom bust cycles that have occurred in the past, a lot of that is really caused by the Fed to a large degree because of the fact that they'll manipulate interest rates where differently than they would otherwise be. And then you get, money going to places where it otherwise shouldn't go, whether it be the housing bubble or even the dot-com bubble. And then what kind of comes from that, the bubble that we just got now with all this stimulus, the inevitable downside to that is the bust that comes, right? It comes again because the economic gravity that we talked about can't grow things faster than their underlying rate for too long before something blows up. So, I think I would prefer to see markets decide and price risk in their interest rates appropriately. Because then you usually don't get that kind of froth in the first place where somebody can get some stupid loan because, rates are held artificially low rather than where they should be based on where risk is pricing in the economy. So if the Fed does have a role, if you want to twist my arm and say I couldn't abolish them, I guess I would say, just make it so that there's liquidity available at overnight rates to the banks so that like systemically there's no risk, right? So like a bank gets a big run on deposits or something like that, they can go borrow money from the Fed temporarily if they put up collateral and they pay a penalty rate or something just to like stabilize the system. But outside of that, I think they're causing way more harm than good.
And then just get rid of the Fed funds rate as like an official rate.
Yeah, let the
Sort of
repo markets and the overnight, lending markets take care of it.
just figure out what that should be.
And the Fed can just be there as a backstop in case things get really crazy and you need temporary liquidity or something. Yeah.
Yeah, or if there had to be a Fed funds rate, you would just say, all right, we're just going to pick a rate that makes sense based on the growth. It's going to be just like 1% forever kind of thing, or not shouldn't be zero, or 25 bips like it was, but
Yeah, I mean, you like to see
like
it
that.
floating with the market, right? So that the market could determine that, and the market's going to be a lot better at figuring out when it should go higher because there's too much risk, But if you were going to manually set it, maybe the closest thing you could do is what they call the Taylor rule, which basically takes economic factors and says that there really should be no guesswork to it. You should basically calculate where inflation and a few other things are and then just peg the rate to that, which I guess that would be better than, just kind of what I view as fairly arbitrary with how they're doing it now. But yeah, I mean, I think it's kind of odd that most people, especially people in business, we realize things like rent control are ridiculous and stupid. And, anytime that the government tries to step in and plan too much stuff, the results are always bad, right? Yet, like, these guys in the Fed get to plan interest rates and try to plan where prices are in the economy, and interest rates are the price of money, and you price so much stuff off of those interest rates that, like, but they just get a complete pass, right? Like, nobody thinks, should we have these guys planning all that stuff, even though it's terrible in every other aspect of the economy when we try that. So
yeah, it's all because it's well intentioned. I mean, right, with rent control, I mean, they're trying to help out people that can't afford their rent, and then same thing with this. We're trying to help the economy not get too overheated or too too slow, but then it's always overshoot, like you're saying, and create a new problem.
Right.
So same thing, right? I think what in Seattle or Washington, they needed, like, they were floating this Amazon tax idea. I don't remember if it ever went through, but all of a sudden there's, headquarters number 2 coming, it's like this, great plan, floating that idea out there.
Right.
So,
yeah. And I'm not much of a politics guy. I usually consider that broadly a waste of time, but sometimes it just intersects with economics to the point where you make comments on it that might sound political, but I don't really have a political dog in the fight one way or the other. It's just a matter of thinking about, like, what actually happens, what actually matters in the economy, and how those things are going to impact, the real world outcome. So
yeah, that's how I feel too. And even, we live in Illinois, so whoever is going to represent us, basically, it's like a certainty when we're voting anyways.
Oh, sure.
So it's not, we're not in a swing state here, so
right.
It doesn't, but yeah. So what about, I guess, anything else maybe that you have a understanding on with interest rates or commercial real estate that you've sort of figured out and think would be good to share with people listening and watching? Something maybe you feel like maybe you have a good handle on, but like a lot of people don't. Let's say
that's a good question.
Less common, I guess.
Yeah, I mean, I feel like a lot of what I've been talking about has really just been the interest rates and long-term bond yields and what drives them, right? I think we covered that pretty well, because I think that's really the key here, is that you gotta dig under the surface and see what's going on, and not just assume that because inflation is high, it's the same as the last one, or think that bond rates can just be high just because they were high before, those kind of things. So I would kind of stress, thinking through breaking the economy down into, like, the base layer of what's expected, and then you kind of, it helps you to understand going forward kind of how that looks. And then I think, at least from, like, the Twitter standpoint, I think if there's something that I would stress to people that are out there that are, like, getting started new, it would just be that you got to really understand what's going on with your leverage in real estate. I think I see a lot on Twitter about people advocating for just leverage, right? Like, the way to get into real estate, the reason why real estate is great is because you can borrow all this money that you don't need to put up yourself, and then you can get these huge returns, and you've got, like, this 10, 12 year track record now of everybody doing that and making a killing, and then going and bragging to their friends about all the money they're making in real estate. But I would just emphasize that you need to know, especially in a market like this where rates have been rising and where we may see a little bit of a plateau in NOI growth, that if you're leveraged like crazy and you have a refinance coming up, or a bridge loan like you talked about or something, the margin for error on something like that can be a lot lower than you think before you can get into serious trouble. So, if you have, like, an 85% LTV bridge loan and you need rents to go up 10%, 20% a year to get to the point where it makes sense for you, and then your loan's coming due in 18 months, it doesn't take much of, rents don't even have to go down. They just have to not go up as much as you think. And cap rates don't even have to really go crazy. But if they're up 25, 50 basis points, you can all of a sudden be in a position where your loan amount is higher than the value that you're going to get. And you're going to end up giving the keys back to the bank. So if people are out there like just getting started right now, like the one thing to really focus on is like understand deal structure and how that will impact your investment and how that impacts your risk. And you could really de-risk a deal by just not going crazy on leverage. And if you get a long-term fixed rate loan, like, if you can do a 55% LTV loan and, it's a 10-year loan based off the 10-year treasury, the odds that something really bad happens to you if you have a good stabilized deal in a good market are very, very low. Right. And if you're toward the top of the cycle, maybe just be okay with that instead of trying to hit a massive leveraged home run out of the gate right now. I think that just makes a ton of sense to do that rather than worrying about where things are going to be in 12 to 18 months and whether or not you're going to, owe a bunch of money to the bank and declare bankruptcy and everything else. So that's kind of what I would have people focus on, I think.
Yeah, that's where real estate usually is not such a make money quick game like it's felt like it's been the last few years.
Right.
And so that's a great point where I think one of my best deals so far, I bought in March 2007, but it was a 10-year hold. That's why. Like it wasn't, I didn't need to sell it in 2009 or 10. And there was some element of value add. It was a 3-unit. And then I doubled the size of one of the units and I over time reinvested in the property a ton and improved it. But I bought it for $670,000 and sold it for $1.2 million too.
Wow.
And so but I didn't have a ton of investors to answer to on that in a 2-year loan or something where this, it was a 30-year loan. That it was a 5-year arm or a 3-year arm. I think it was a 5-year. I remember really kicking myself because I paid a higher rate to get that, lock it longer. It was 7.5% interest and I paid up, I think, where I could have had something in the low 7s or high 6s to do a 3-year.
Okay.
But that was a really sweet rate in 2007 for that kind of product, at least. So that I was, remember paid up for that. And then, but then I kept it. And when the rate adjusted, it dropped and, everything was just clicking right along with the deal. So it turned out because I had a good hold period and I didn't term out, so to speak, and have a hard maturity at any point when things got tough. So that would be a tip I would throw in to build on that where, right, if on these deals, the longer you can spread out, you can get a further out maturity, even if it's not a full fixed rate term. But Freddie Mac Small Balance has a really great program where you can get a 5, 7, 10-year fix from them, but they have the option where you can get a 20-year term on that. Oh, wow. So if you're in that's for deals where the loan amounts under $5 million in most markets and under 7.5 in the major markets like Chicago and the bigger markets. And then to add on to that, like something you could put in your model, which we have, and you realize the necessity for it is, to your point, you see what your current loan balance is, and then make 2 more pro formas on that, where one would be, all right, well, now when I'm going to have to refinance, let's say you have your 3-year loan, have 2 pro formas next to that. One where your rents didn't grow at all, right, and then just stress test what you need to just refi your current balance. Because right now, if you were to go, all right, I buy a deal and I'm assuming I'm going to grow my rents 5% a year or whatever the buyer's doing, and 6 months ago, what would we be assuming for our interest rate in 3 years? Right, 4.5. Maybe you think you're getting aggressive on. Yeah. I'll add 100 bips on. I'll be conservative. Yeah. And poof, they go to 5.5. Right. And so now you change the thing and say, what does it look like at 5.5? And yeah, if you did a 75%, 80% LTC LTV loan, you're not going to be able to refi your balance, and you're going to be a forced seller, or you're doing a capital call, and who knows if your investors are up for that. Right. So that's something to build into your model. And then I guess I said 3 pro formas because one would be kind of your day one. One would be, what does it look like if I didn't grow my rents? And then, have one, what it looks like when you do grow your rents, kind of what you assumed would happen. But still with that, even really stress test the different growth rates and interest rates you need.
Yeah, I love that idea, and I like doing it a few different ways too, right? What kind of exit cap would you need? What kind of rent growth would you need to keep your DSCR covenants in play, right? Or how low could rent growth drop before you hit a 120 or a 110 or a one flat or whatever it might be? I think that's hugely valuable, and if you do that enough, you'll realize like what are the big drivers here and what are the big potential killers, and it's always leverage, and it's always, like I think your example is perfect. The term. If you have a gun to your head and you become a forced seller, like that deal was a great deal, but if your loan was maturing in March of 2009 or something like that, you might have just lost the whole deal, right?
Yeah, or I would have sold it for like what I paid, and then my equity would have been basically would have been pretty close to wiped out with all the transaction costs. That's what would have happened.
Right. So that's the key, right? Is you got to keep yourself from being a forced seller. And you do that by getting enough term and not screwing around too much with leverage. I mean, there may be a time and a place for it, especially if you feel like you're at the bottom of the cycle and you want to take a big swing, but be really aware of the fact that, that can take you to zero in a hurry if you're not careful.
Yeah. And I think that's a good point to end on. I mean, I think that's, anything else you wanted to get into, or what do we?
No, I think that was a great conversation. I think we covered a lot of ground there, but.
Great. Yeah. Thanks for being on. If anybody watching, listening, they want to get in touch with you, what would be the best way to do that?
Just hit me up on Twitter. I think Phil_McAlister on Twitter. You'll probably find me there and we'll get into it. Feel free to shoot me a DM or whatever. I'm always happy to talk to people and talk shop. So it's a lot of fun.
Yeah. Great. Yeah. Thanks for being on, and a lot of good information on your Twitter feed or whatever it's called, the page with all the tweets. But and we'll link to that in the show notes or description of this episode, so you can find that. But yeah, thanks for being on. Great job.
Thanks, Drew.
Great. Until next time, everyone, thanks for joining us, and we'll see you on the next episode. Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.